Welcome to another day trading for income video from A4TG. In today's video, we're going to discuss the importance of using long-term charts to confirm our trend direction. From our scalping approach that we normally use, we're going to use a 1500T chart for the Russell 2000 or the TF E-mini as our long-term chart. Now we got to realize that long-term charts provide the most accurate depiction of the market's direction, and our Paint Bar Factory direction bars do an incredible job of providing an easy-to-view chart to stay in sync with trend direction. Now, it's really important that we note that longer-term charts are not very effective for scalping, since it's difficult to find laser-like entries that we normally get in our short-term 133 tick charts. So if our active trading strategy, along with our entry rules, call to only take trades in the direction of the moving averages, then we're only going to go long with blue bars, and we will only take short positions when our PBF bars are red. Of course, we want to get confirmation from the squeeze in either direction. So the other purpose of the 1500T long chart is to provide early detection of and confirmation of a reversal. We follow the same rules of our PBF direction bars, which are a colored bar close above the yellow bar for an upward reversal, or the other side of that, a red bar close under the yellow bar for a downtrend reversal. Now we like to use this this band indicator that you see here, this EMA bands, and it's called the GMMA, or Guppy Multiple Moving Average. The indicator is based on two bands formed by 6 EMAs each. The fast or blue band is formed by EMAs of 3, 4, 6, 8, 10, 12, 15 periods or candles, and the slow red band is formed using 30, 35, 40, 45, 50, and 60 period EMAs. The fast band shows us and represents what the short-term traders such as day traders, intraday traders, and scalpers are doing, and the slow band or the red band represents long-term players, mostly investors. So very simply, the way we use or apply GMMA is by observing the relationship between the two bands, so that the more separation with each band and within the bands themselves, the stronger the trend. When we see the bands compressing, we're in a consolidation period. Of great importance and very important to note is the direction of the slow red lines, which clearly tell us the direction of the trend, and then conversely the fast blue line shows us the opportunities or trading swings. So how do we leverage use of our long-term chart? Well, we definitely use it to make sure we are trading in the direction of the trend. Let's say our trading rules dictate that we should only be trading with the EMAs, which we can see in this chart are trading downward. When we see a yellow bar on a long-term chart, the first thing we must think is reversal, and we must become more alert to stay out of re-entries in our stated direction. We do see a reversal failure right here with the PBF direction bars on this chart, but diversification and the disconnect between the PBF squeeze bias line and the histogram also alerts us to sit on our hands. From a big picture perspective, we see consolidation during this period, which is also confirmed with a tight area or period in the PBF squeeze. So we can see here that eventually we get a reversal sequence with a previous low candlestick hammer followed by PBF direction bar and squeeze confirmation. Right around this area we should see our opportunities in our midterm chart and laser entries in our short-term charts. So to summarize, we use long-term charts to really keep us in the trend, especially when our rules say this is the only direction we're going to trade in. But also whenever we see a yellow bar in a long-term chart, we really want to think that there's a possible reversal coming up, so we shouldn't be looking for re-entries bouncing off of the moving averages.